Today we are analyzing FleetCor Technologies, ticker FLT. Over the next few minutes, I'll discuss my thoughts on both the business quality and its valuation. First up, we have a market cap of $15.9 billion, enterprise value of $19 billion. You can see about $3 billion in net debt on this business. Not a significant amount, but it's about 15% of the overall enterprise value. Operating the IT services space tends to be an area where you have some good economics. So they are digital payment solutions for businesses, control, purchase, and make payments. Corporate payment solutions such as accounts payable, virtual cards, single-use card numbers, cross-border, so you can pay international vendors. So it looks like it's really of a corporate-focused IT services. They have expense for employee expense management, gift card management programs, so various things associated with kind of the corporate structure for IT and really kind of digital payment solutions. Interesting area. The beta is a little high at 1.2, but nothing significant there. Return on invested capital chart looks interesting. We only have data back to 2008, but if we count from 2009, maybe this is an IPO time frame or something like that, some sort of startup time frame in terms of our data. We can see pretty strong, stable numbers. From year to year, there's very little variation in the return on invested capital. That tends to be a sign of a high-quality business. You see here 12.12, 12.14, 11.94, 12.89, just very little variation. You don't see cycles. There is a little bit of a decrease here. For all I know, this is some sort of acquisition-related piece, but it's not cycling. It's not up and down. And overall, year to year, you see a lot of stability, and that's really good sign for a high-quality business. The other piece here is that every year of data we have is profitable. Anytime you're only showing profits, even during stuff like recessions, like this 2009 timeframe or 2020 when you had COVID, that's a very strong sign for the overall performance of the business. Everything here is indicating a high quality business. When you go to 10-year median margins, it also leaps out that way as well. 80% gross profits and an amazing 40% free cash flow margins. These numbers are outstanding. Absolutely world class. You don't see 40% free cash flow and EBIT margins every day. This is something that immediately leaps out to me as an exceptional number. So I get really excited when I see something like this. 80% gross profit margins on their own are quite significant, but turning those into something as high as a 39%, 40% free cash flow margin is very, very impressive. Likewise, you can see that although these are kind of like a 10% return on invested capital, they're turning it into an incredible 22.5% return on equity, which is absolutely amazing for the overall performance of the business. So they are having to use debt to achieve that, but that's a very good number. Anytime you're over that 20% mark, you start to get really excited in terms of what the internal economics of the business might be. The second piece that pairs with really well is this 10-year CAGR on growth. You're seeing that all of your revenue, assets, free cash flow, and EPS are growing at 17 to 18% a year. They're basically growing in line. This is a very stable number, very reliable number. They all are going together, which I really like what I'm seeing there, that they're growing in line. You're not having assets growing faster than revenue. You're not having EPS growing faster than revenue. Everything's growing in line, which is good because that means it's the sort of like a sustainable type growth rate. You're not worrying about, having had operating leverage, and so you need that operating leverage to get a good return, or you're having, assets growing super fast or something like that. This is what you'd like to see in terms of like what you could see potentially repeat over a year-over-year basis. Now, again, they're using return on equity here, but what I like here is that the return on equity number exceeds your growth rates. That's very important because it means that you could continue to grow without having dilution. And so we're going to, of course, analyze that, see if they've diluted in the past. But at least on this data, it looks like they wouldn't have needed to. Now, the PE ratio is also very exciting because you see a PE of 16.7. That's a really attractive number. I like to buy stocks with a PE of 15 or less, but 15, 16, you're basically right in that margin point where you have a 6% earnings yield. And when you combine that with 17% growth rates, return on equities of 22%, maybe, you're looking instantly at this kind of middle teens potential type returns with this sort of setup if you can repeat it in the future. So that's very exciting type numbers. Likewise, when you look at your revenue growth on a line by line item basis, you're seeing that double digit revenue growth isn't exceptional. You're seeing numbers like 26, 34, 42%, 22%. 18, 20%. You do have 3 years here of single digit growth, but they're the high single digits, 7, 8, 0.8, and 1 year of decline, which was, of course, COVID. That's not a big problem because it only took a single year to come back and match and exceed the previous high, which was 2019 on revenue. So you continue to grow and compound at a very high rate. Looking good on those numbers there. So when we get down to the operating profit line, we start to get some interesting data. You see 421 to 1447 as you've already more than tripled in a single decade. That range of tripling to quadrupling in a decade is a very attractive mark for potential investors to hit. It shows very good signs for you as a shareholder. But even more impressive, their EPS has gone from $3.36 to $12.42. So you've actually closer to 4x over the course of a decade when you look at the EPS line. That does signal to me that potentially we have some share buybacks. That would make me really excited if that's what we find. And I hope that we're seeing a declining share count. Next up is the income statement. But if you're enjoying this video, hit that like button. And I'm going to convince you to try and subscribe by the end of this video by adding as much value as I can in the next few minutes. Let's look at our income statement here as well. Again, it's really easy to see this big gross margin when you see the gap here between revenue and cost of goods sold. Although you started making $1 billion in revenue in 2014, you still have not gotten up to $1 billion in cost of goods sold all the way in 2022. So I like what I see there. You are growing your SG&A quite rapidly. So I do think this matches kind of a decline in some of the gross, some of your operating margins. Let's see here. So yeah, you started out at 47%. You got down to 42% by the end of the decade. So it does match what I'm seeing here is that you're having to grow your SG&A a decent amount to keep up with the growth in this business, but it's not astronomical. Also, you can see that the net interest income is not a significant portion of the operating profit. It's less than 10% in general of the operating profit, or in that 10 to 15% range. So we don't have a lot of concerns that rising interest rates are going to distort the ability of this business to continue to make a profit. And what I see here at the bottom is exactly what I wanted to see, which is that the company has bought back shares over the course of a decade. Now, it's not been sure and steady. It looks like for a few years, you actually increased your share count from 2013 to 2016, and you peaked at 95 million in 2016. However, over the next 6 years, it looks like you retired about 20% of the shares outstanding over a 6-year period. So you're going to be adding here somewhere in the range of 2 to 3% of additional EPS growth over and above your operating profit growth simply from those buybacks. I really like that I see that. It looks like they've turned a corner in how they're managing their capital structure, and that makes me really excited about the future, because when you're shoveling money into buybacks instead of diluting yourself, and you're still able to maintain these growth rates at a 17 to 18% rate, then you start to get into a situation where investors can start to get very nice 17, 18% returns for themselves as a shareholder. Let's go to the balance sheet. You can see that the balance sheet has a bunch of goodwill on it. There's basically no PP&E here, okay? So let's go to the PP&E and say you had $300 million in PP&E. But we go back to our income statement, we see that we have net income of $954 million. So you have 300% returns on your PP&E. This is a very capital-light business. Now, why do your returns in capital show lower than that? It's because you have goodwill and intangible assets. You have $7 billion in intangibles here on your $14 billion in assets. So that's really distorting your return on capital. So it makes the numbers look worse than they are. What that says is, okay, your return on invested capital is 10% here, but really on a tangible basis, it's 20%. You take away those intangibles, you double your return on invested capital. You're in that 20% range even before you take into account that they're using debt. So your return on equity gets very, very attractive. It's why in the most recent year you're showing returns on equity like 27, 35%, is because the numbers in this business are very, very strong. And those are the types of numbers, of course, that you want to target as a potential shareholder. Let's look at our debt. So you have basically 10x your debt over the course of a decade, and that sort of 10x growth is kind of concerning, but because they're probably not investing a bunch on the cash flow side in terms of PP&E, this is really probably acquisition based. You're going to see these jumps in debt occur in like 2013 and 2014. You see this gap here. You add about $1.5 billion in debt, but of course you added a bunch of goodwill and intangibles at that time. So you made an acquisition, you took on debt for the acquisition, and now when does the debt go up again? You went up $500 million here, but you made an acquisition in 2015, 2016. You took on some more debt in 2016, 2017. You made an acquisition. So it makes sense for when you're taking on the debt. It's not just like willy-nilly all the time. So I'm okay with the fact that you're using some debt to make these acquisitions, but it's not just part of your, annual basis of how you're running your business. But likewise, you can see your returning earnings 10x over the course of a decade. So again, that's not really a major concern. Cash flow statement. One of the things I like for reliability of earnings, you have relatively low depreciation and amortization here, and that's matching your low PP&E investment. In fact, your depreciation and amortization is higher than your PP&E investment, which is a good sign that you're not having to throw chunks and chunks and chunks of capital back into the business. You do see pretty steady acquisitions each and every year. A lot of them are relatively small, but that is taking some of your capital to continue to make those acquisitions. Now, that is one concern, that a lot of our growth here isn't necessarily all organic growth. Although we're getting 17 and 18%, I would have to assume that it's not 17% organic growth. You have some inorganic growth because they are spending money on acquisitions. It would be worth kind of parsing that out as a potential shareholder, like how much am I dependent on acquisitions? What is my organic growth expectation going forward? Now, they do have stock-based compensation, and it's grown to about $100 million in stock-based compensation per year by 2022. But you can see that they're buying back over $1 billion in shares each year now. And so that big gap there is going to allow the shares outstanding to decline over time, and that's perfectly a good setup. Likewise, they're not paying out dividends, which I'm actually really okay with, because I love to own companies where they spend all of their excess capital on buybacks instead of dividends. It makes it really attractive for timing your investments in and out, because you can just know that if you want to own the stock, then you want to become having the company making buybacks. If you don't want to own the stock, then of course, or if you don't like the company making buybacks, then you probably shouldn't be owning the stock, because it means that maybe they're paying too high of a price. Maybe you have some better opportunities. It does show what I said here is you had about a 3-year period where their shares were increasing. This was this early 3-year period here before they had really started on their buyback campaign. And also, of course, probably lining up with these acquisitions, you might have issued some shares during those acquisitions. Overall, everything here looks really, really good. The capital allocation setup is good. They are taking on some debt, but again, the debt is matched up across the acquisition time frame, so that's really attractive. And your returns on capital are amazing. Again, your overall returns on capital being like a 20% number, in terms of you take out these intangibles, and then overall, just like on your actual PP&E is just really, really low. You like that sort of return. Very attractive growth rates, very attractive income economics. These are amazing unit economics. I love what I'm seeing here from FleetCor Technologies. So I think it's going to be an instant add to my watch list. High quality business. No years of losses, just profitable every year. Very good margins, great growth rate, and actually an attractive valuation. This sounds like a really good valuation for a business of this quality. I'm very impressed. It's not normal that you would see a valuation like this for a business that's growing so fast, has such good economics, such high returns, no years of losses. Why is it trading at this valuation? I think most likely, based upon what I'm seeing here, this company is probably a little bit undervalued. Because of what I'm seeing. Now, I need a better understanding of their organic growth rate before I'd want to buy, but overall, it easily hits my watch list with everything I'm seeing here, and the evaluation is one of the most attractive I've seen for a company of this quality in the current market. Thank you for listening, and if you learned something from this video, if you like this video, please hit that like button. That really tells YouTube that you're enjoying the content. And if you are enjoying my content, you should become a subscriber. If you're not already a subscriber, hit that subscribe button. We're working through every company in the S&P 500, and I'm finding the best companies for you and putting them in this playlist at the top, which is my watch list playlist. These are the best companies I've found in the overall S&P 500. Best unit economics, best quality, best valuations. Those are the things that I'm trying to find for you as a potential shareholder. So through all that, I'm trying to educate you. Be a subscriber. Check that out. And if you want to learn how to use this software, if you want to be able to use something like this to make quick investment decisions like I am doing, quickfs.net. My affiliate link is the first link in the description below. Using that link to sign up for a free or paid account is a great way to support the channel. Check it out. Thank you for listening, and until next time, stop paying fees, start building